In the United States, taxes are not just numbers on a paycheck or a form filed once a year. They are an invisible force shaping everyday life, influencing decisions about work, family, savings, and the future. And yet most Americans move through this system without truly understanding how it works or how much control they actually have over it. Because the biggest secret of the US tax system is not hidden in loopholes or gray areas, but in plain sight, written clearly into the law, quietly rewarding those who learn the rules and unintentionally punishing those who don't. And this is where the story of tax savings truly begins, not with the wealthy or corporations, but with ordinary people who unknowingly overpay thousands of dollars every year simply because no one ever explained how the system was designed to be used. At its core, the US tax system is a behavioral system, meaning it taxes you less when you behave in ways the government wants to encourage, such as saving for retirement, investing in education, buying a home, starting a business, supporting a family, or planning long-term, and taxes you more when your money flows in ways that do not align with these priorities. But most people are never taught this, so they assume taxes are fixed, unavoidable, and out of their control, when in reality, legal tax saving is less about earning less and more about structuring income intelligently. Because the IRS does not ask how hard you worked for your money, it asks where the money came from, how it was used, and whether you followed the rules attached to it. To understand tax savings, you first have to understand how income is categorized in America, because not all income is taxed the same. Earned income from wages and salaries is taxed the most aggressively, while investment income, retirement income, and business income often receive preferential treatment, and this alone explains why two people earning the same amount can pay vastly different taxes, one struggling paycheck to paycheck, while the other quietly builds wealth. And the difference is not cheating or evasion, it is knowledge. When an American receives a paycheck, taxes are already removed before the money even reaches their bank account, including federal income tax, Social Security tax, Medicare tax, and often state and local taxes, creating the illusion that taxes are automatic and unavoidable. But withholding is not the same as final tax liability. And this is where many people lose control, because withholding is merely an estimate, while your tax return is where the real calculation happens, and that calculation is based on deductions, credits, and adjustments that most people barely understand, let alone optimize. The government offers two primary ways to reduce taxable income from the start: the standard deduction and itemized deductions. And while the standard deduction is simple and automatic, itemized deductions reward those who spend money in government-approved ways, such as mortgage interest, charitable donations, medical expenses, and state taxes paid, meaning the tax system subtly encourages homeownership, generosity, and certain lifestyle choices. Yet millions of Americans never itemize because they don't track expenses or believe it's only for the rich, when in fact middle-income families often qualify without realizing it. But deductions are only the beginning, because deductions reduce taxable income, while tax credits reduce the actual tax owed, dollar for dollar, making them far more powerful. And this is where tax savings becomes transformational, because credits like the child tax credit, earned income tax credit, education credits, and energy credits were designed specifically to put money back into the hands of working Americans, yet many eligible people never claim them due to confusion or fear of making mistakes. However, the real foundation of long-term tax savings in the US lies in timing, because the tax system rewards people who think in decades instead of months. And nowhere is this more evident than in retirement accounts, which are not just savings tools but tax planning tools disguised as financial products. Because when Americans contribute to a 401k or traditional IRA, they are not just saving money, they are legally lowering their taxable income today, often pushing themselves into a lower tax bracket while deferring taxes until retirement, when their income and tax rate may be lower. And this single strategy alone has saved trillions of dollars in taxes over generations. Yet millions fail to use it fully, either because they underestimate its power or delay participation, not realizing that time is the most valuable tax asset of all. The genius of the system is that it allows Americans to choose when they want to be taxed, now or later, and smart tax savers use this choice intentionally, balancing present-day deductions with future flexibility through Roth accounts, where taxes are paid upfront in exchange for tax-free growth forever, illustrating again that the system is not unfair, it is selective, favoring those who plan. Another critical misunderstanding is tax brackets themselves. because many people believe earning more money pushes all income into a higher tax rate, discouraging ambition. When in reality the US uses a marginal tax system where only the top portion of income is taxed at higher rates, meaning growth is never punished. The way people fear but ignorance creates unnecessary anxiety that keeps people financially stagnant. As this foundation becomes clear, a pattern emerges. Americans who save the most on taxes are not necessarily the highest earners, but the best planners. Those who align their financial lives with incentives already embedded in the law. Because tax savings is not a one-time event at filing season, it is a year-round strategy shaped by everyday decisions. From how income is earned, to how expenses are tracked, to how future goals are structured. And this is why tax professionals emphasize planning over preparation. Because once the year ends, opportunities disappear, and what remains is damage control, rather than optimization. The tragedy is that schools rarely teach this, workplaces rarely explain it, and most people only encounter taxes as a stressful annual obligation, instead of what it truly is, a system that can either drain wealth or quietly build it, depending on how well it is understood. And this misunderstanding fuels resentment, misinformation, and fear, when clarity would instead empower individuals to make smarter choices. By the end of this journey, it becomes clear that tax savings in America is not about tricks or loopholes, but about alignment, aligning income, timing, purpose, and behavior with a system designed to reward responsibility, foresight, and contribution to economic growth. And this is only the beginning, because once the foundation is understood, the deeper strategies used by families, investors, and businesses reveal how taxes, when managed legally and intelligently, become one of the most powerful wealth-building tools available. Setting the stage for the next part of this series, where we move beyond fundamentals and into the strategies that quietly separate financial stress from financial security. Once the foundation of the US tax system becomes clear, the next layer reveals where real, measurable tax savings begin to take shape, because this is the point where theory turns into action. A distinction that sounds technical, but determines whether tax planning merely reduces paperwork or actually changes lives. Because deductions lower the amount of income that gets taxed, while credits reduce the tax bill itself, dollar for dollar, making credits exponentially more powerful. Yet most Americans focus on deductions. Meaning that failing to understand credits is one of the most expensive mistakes an average taxpayer can make. The child tax credit alone has historically provided thousands of dollars per qualifying child, directly reducing taxes owed and sometimes generating refunds. Yet confusion about eligibility, income phase-outs, and filing status prevents millions from claiming its full value. And this pattern repeats across the tax code, where opportunity exists but clarity does not. For lower and middle-income households, because the American tax code actively encourages investment in learning by offering credits such as the American Opportunity Tax Credit and the Lifetime Learning Credit. And choosing incorrectly can silently increase tax liability for years, not because of wrongdoing, losing valuable tax advantages in the process. Beyond credits, deductions still play a vital role when used intentionally. And this is where the standard versus itemized decision becomes strategic rather than automatic, because homeowners with mortgage interest, families with charitable giving habits, individuals with high medical expenses, particularly through health savings accounts, which offer a rare triple tax advantage, allowing contributions to be tax deductible, growth to be tax-free, and qualified withdrawals to be tax-free, effectively turning healthcare planning into a stealth retirement strategy. But because these benefits are often offered quietly through employers or buried in enrollment documents, they are missed by those who don't actively seek understanding, reinforcing the pattern that tax savings favors those who engage rather than those who ignore. One of the most emotionally charged areas of family tax planning involves dependents. Shaping outcomes instead of accepting them, and this is where the emotional shift happens as taxes move from being a source of stress to a tool of stability, because when families see refunds not as lucky outcomes but as planned results, confidence replaces confusion. By the end of this stage, it becomes clear that tax savings is not about isolated tactics but about coordination, coordinating income, expenses, benefits, and family structure across time. And this coordination sets the stage for even deeper strategies. Because once individuals understand how deductions and credits interact with life events, the next evolution naturally follows, moving beyond households and into the world of investments, retirement optimization, and long-term tax efficiency, where the difference between paying taxes forever and controlling when and how much you pay becomes unmistakably clear.